welcome to PhillipCapital Experts Talk. My name is Lin Sin from Unit Trust Research. Today, we are privileged to have Ms. Louise Kernohan, Investment Manager of UK and European Equities team from Aberdeen Asset Management, to take us through the investment prospect of European equities. Ms. Louise has joined Aberdeen via the acquisition of Deutsche Asset Management businesses in 2005. Besides attaining an honours degree in mathematics, physics, and philosophy, Ms. Louise has also graduated with Masters of Arts in Management from the University of Durham. In addition, she is also a CFA charter holder. Thank you, Ms. Louise, for taking time to attend this interview with us. Let's start off with the European economy macro view, shall we? After 6 quarters of contraction, Eurozone's economy has finally shown signs of recovery, albeit a moderate one. In your view, how will US unraveling its monthly bond purchasing program eventually going to affect the euro economy and hence the equity markets?
You're right in saying that Europe does appear to be having some positive signs at the moment. In terms of the effect of the potential tapering of quantitative easing in the US, I think we've seen from the effect on the European equity markets earlier this year that it will have an impact on the market. So, for example, earlier in this year when the US Fed announced that they were going to taper, that had a clearly negative effect on the market. And then later in the year when they said that it would be delayed, that had a positive effect. So I think it's clear that there will be an effect. Now, when tapering will happen and the extent of the effect on European equity markets remains to be seen. I think the US has a way to go in terms of their own recovery. So I think any tapering will be fairly measured and potentially still a little way in the future, not just yet. So that gives Europe some time, and I think it will be a measured approach. So I don't think the impact will necessarily be very, very dramatic, but it does remain to be seen. I think what's really important to remember is that there are a lot of other variables that affect the European markets. And what's really important for us at Aberdeen is actually, from the corporate point of view, they're stronger than ever. They've been deleveraging over the past few years. Balance sheets are very strong. They remain in a very strong competitive position. Remember, these are global companies that are listed in Europe as well. And valuations are actually quite reasonable in Europe. Europe did perform very strongly in 2012, the equity markets, but valuations remain quite reasonable. So whilst there's a lot of macro effects which are going to have influence on the European equity markets in the future, we remain very positive from the corporate point of view.
As the fundamental issues like excessive budget deficits, lack of competitiveness, and loss of confidence in the financial markets have yet to be resolved, and many have even called for structural reform to supplement austerity policies down the road. What is your stance on the Eurozone's policy moving forward, and what is your base case on the euro economy?
I think there has been progress made in terms of the reforms in Europe and austerity, but I think what is very important to remember is that there's still a long way to go. We've seen the headlines over the weekend about what's going on in the Italian politics, and it just goes to show that there's still a lot to be resolved and a long way to go. I think political stability is potentially one of the key factors to ensuring that we do finally get some sustainable recovery. Whilst we've had a positive quarter, that doesn't necessarily mean that we're definitely on the upturn, for certain. But I do think that our base case is that there will be a recovery. It will be slow. There's a long way to go, and there will be potentially quite a few bumps along the road. But I think a long, slow recovery is probably more likely than any catastrophe in terms of break-up or blow-up or anything more drastic like that.
Germany has previously publicly opined its reluctance to share more European liabilities and threatened to leave the single currency. Have the recent Germany general election on 22nd September changed your vision on EU?
I think the outcome of the German election was actually very positive, because I think continuity in terms of policies is extremely important at this time. Merkel has shown a commitment to putting through austerity measures and really trying to take Europe out of the problems that it has. So I think that's positive. I think it's understandable that each of the different countries within Europe does have its own vested interest, but I think everybody ultimately understands that it's within everybody's best interest to get through the crisis together.
Can you share with us on your investment philosophy and strategy?
Yeah, we are very bottom-up stock pickers at Aberdeen and also very long-term. So ultimately what we're trying to do is pick the best quality companies, invest in those for the long term, and try to invest in those companies at good valuations. In Europe, we're very fortunate that we've got some absolutely fantastic global companies. If you think of some of the names which are listed in Europe, for example, you've got Roche, the global pharmaceutical company, which has an exceptionally strong oncology franchise, as well as a lot of other areas where they are a global leader. We have Schindler, for example, the global leader, or one of the leaders in elevators and escalators. So linked to global construction and urbanisation, which has its ups and downs, but you ultimately must think that that is something that will grow in the long term. The industry has very high barriers to entry. If you think of how crucial an elevator is, not anybody can do it unless you've got a very strong track record, and also the competitive advantage is very high and the barriers to entry are high. If you think of the service network, they actually get the majority of their earnings from servicing the original equipment that they sell. So whilst the original equipment sales might be more cyclical, the service element is much more stable. So actually they've got stable earnings, and their global service network is difficult to replicate. And those are just two examples of the great companies that we have listed in Europe. You know, Europe was very early to industrialise, has had good education systems in the past. If you think the two companies I've just mentioned are both listed in Switzerland, which is a relatively small country with a small domestic market. It was forced to internationalise and export from a very early stage, which means these companies have first mover advantage in a lot of international markets and very, very strong global networks. And I think for that reason, we're actually very positive about the companies in Europe, even though the macro situation is much more uncertain. So we spend our time at Aberdeen doing our own research, analysing these companies, always questioning the quality of these companies, the growth prospects, how strong is the balance sheet, is it run in the best interest of shareholders, and also is the valuation attractive, because we clearly don't want to overpay. And we believe that whilst there will always be short-term fluctuations in the market, if you buy and hold the best quality companies, then over the long term your portfolio will outperform.
Do you think that Europe has hit bottom? What are the risks that you foresee, and how do you manage downside risks of your portfolio?
I think it would be a bold statement to say that Europe has hit the bottom. I think the path is uncertain from here. There are potentially going to be some ups and some downs. In terms of how we manage the downside risk, we're very conservative in our nature. For a start, we think the biggest risk in a portfolio is investing in a bad company. So a bad company might be one of those that has aggressive accounting policies, they have too much debt, perhaps they're in an industry which is subject to a lot of change. So just because they're the leader in their industry today doesn't mean they're going to be the leader in their industry in 10 years. So we really see that as being the risk. And we manage our downside risk by really investing in the best quality companies, and also being very mindful to not overpay, because that can be equally as destructive as buying a bad company, is overpaying, because that means if that company disappoints, then not only do you get the disappointment in terms of the earnings performance, but you get the derating, which can be destructive to the share price too. So for us, it's just always focusing on the companies.
Are there any countries or sectors in the region that you favour in particular?
Well, we always look more at the company rather than the country that it's listed in, or the sector that it's classified in. So with that in mind, we don't have any specific sector or country allocations. It's fair to say that we would never avoid a country in Europe just because a company is listed there. So there are in fact some great companies listed in Spain, which we wouldn't shy away from just because it's listed there. So we aim to have a sensibly diversified portfolio in terms of the underlying exposures, but we think in terms of the individual the country, it doesn't matter so much. And it's similar from a sector point of view. Again, we want to have a range of different end markets and a diverse range of companies, that ultimately we've got a nice, well-balanced portfolio. But at the same time, it's all driven from the company level, so we would never say we want to be overweight pharmaceuticals this quarter, for example. It's all driven by the fundamentals, and I think what's also important to remember is that sector classifications can be quite misleading. So in our fund, we're actually overweight the industrial sector, but that includes a whole host of different industries. You've got the aerospace and defence industry, you've got the construction, you've got oil and gas and mining equipment in there. So it's really quite a diverse range, and it doesn't necessarily mean that the portfolio's got a lot of cyclical companies in it, because as I mentioned before with Schindler, they get the majority of their earnings from maintaining their sales, or maintaining the equipment that they originally sell. And it's the same with other companies we own, such as Rolls-Royce, the Aero Engines company, and we're a group who sell equipment to the oil, gas and mining companies. So actually these companies are relatively stable. So I think it's misleading to look too much into industry and country exposure as such. I think you need to look through that to what's actually driving the companies.
Thank you, Ms. Louise, for sharing your insights with us here today. For more information on unit trust, please log on to www.eunittrust.com/. or talk to us at any Phillip Securities branches. Thank you.